Okay, so you have this framework of the three stages of financial crisis. Can you explain what each of those stages are and where we are today?
To be clear, it's a conceptual framework to give people a kind of a sense of where things are. It's not like a hard and fast stage one is exactly this, and at this particular date it shifts into stage two. It's far more ambiguous than that, and then there's often ebbs and flows. Nothing ever goes in a straight line. We could go from stage one to stage two, not really notice it because things kind of blend together. But conceptually speaking, just to get your head around what this process could look like, so you can create a mental roadmap of what might be going on, and kind of give yourself a sense of where you think things are in the terms of progression. That's the problem that we keep coming back to. And I know we'll talk about this a little bit more, but it, as we keep going through time, we get more escalation, more progression, never de-escalation, which suggests we're moving further into these processes. But just very briefly, to put it together in a brief framework, as we just talked about with the bubble is easy to understand. Money just flows into it. Nobody asks any question. Everything seems to be as good as a fairy tale. High returns, low risk. Nothing can go wrong. So money only goes in the one direction. But eventually something happens, and it's usually a combination of somethings that take place, which causes people to say, you know what? That's ridiculous. There's no such thing as high rates of returns or risk free. We need to start taking a closer look at what's really been happening. And as more people start asking questions, they don't like the answers that they get. And suddenly, for the first time, what I call stage one is where money starts to flow out. Now, there's always money in and out, but by and large, during the bubble period, money flows in overwhelmingly in that one direction. In stage one, more than usual money starts to flow out because people are asking questions for the very first time. They're actually scrutinizing what's been taking place, and they're not liking what they're seeing because, of course, they're not going to like what they're seeing because we just went through a bubble with all sorts of stupid and garbage and everything else. So for stage one, some money starts to go out. However, that's really it doesn't lead to any further consequences because as in stage one being a preliminary early part of the process, there are still people who are going to believe in the fairy tale and the fantasy. So there's still investors who are willing to put in money, especially if they think they're getting a discount for it. Plus, you have the financial system, the regulated financial system, the banking sector, which more likely than not is going to stand behind in this case, shadow banks as they start to experience some uncomfortable conditions with outflows. So you got some money that goes out, but you have ways to rebalance money so that these shadow banks, for example, that are experiencing outflows don't have to actually start selling assets, which is what really determines a financial crisis. When there's forced distress and even fire sales, that's where things really get bad. So in stage one, you've got people questioning the bubble and all of the assumptions that went into it. You've got enough people who are doing it that you get some significant outflows. But in stage one, they're relatively balanced by bank emergency lines of credit or new investors bringing money in. And so largely, you can tell something is different, but it doesn't really look all that bad. And that's kind of where we went through for the last 6 months. Lots of stage one. We've seen confirmation for it. Hedge fund investors have been withdrawing funds from a lot of these hedge funds to the point that it's created issues for the hedge funds. But we've also seen banks that have issued lines of credit or have allowed these shadow banks to draw on their lines of credit. So they haven't had to really force sell anything until recently. So what happened last week was one of the most well-known shadow bankers, Blue Owl, admitted they just had to sell some assets and it wasn't voluntary, it was a forced selling. So that was the first instance of stage two behavior. Now, it doesn't necessarily mean that we are in stage two. It means that for the first time, we can confirm that something like stage two has taken place. So stage two is where we go from stage one, but the outflows either pick up or usually more investors get cold feet. So the outflows begin to pick up on that side. And on the other side, there are fewer new investors willing to put money in because they're starting to ask their own questions. And for the first time, when you get deeper into stage two, the banking sector says, you know what? Even though you have a pre-existing line of credit with me, I'm not going to honor it. I'm going to cut that thing up and just cut my losses with you because right now all the losses are being borne by the regulated banking system. So in stage two, you get to the imbalance. So you have money flowing out for the first time in stage one, but then the money outflows pick up to the point where they're not being balanced by inflows or the ability to find bridge financing. And so for the first time, what you see is forced selling because if you have more money going out than you have money available to come in, you have to sell your assets. It's just basic maturity transformation. We see this in every single crisis. That's why, this is a basic crisis template, not just private credit. So you get the forced selling that tells you that things have progressed another step into stage two.
Can I just ask you a quick question on the stage two there?
Sure.
Because when that happens, you said Blue Owl have started this essentially. Is it the kind of thing that once someone spots this as a problem, it's like a domino effect? Because once they start forced selling things, everyone else is then put in a position where they need to start selling the same assets.
That's the danger when it gets to forced selling becomes distressed selling becomes fire selling. So there's a progression within progressions, and all this. That's why it's a simple example just to understand conceptually what's going on. But yeah, that's really what happens when you progress from stage one to stage two and eventually stage three. It's really just that once the selling starts, it creates these knock-on effects. So what Blue Owl was forced to sell, and their price, they made sure that everybody knew the price was very close to par. It was actually a bit less. There was a bit of a discount there. But then this week, we got confirmation of another fund called New Mountain that actually had to also sell assets at around 94 cents on the dollar. Now, it's not exactly an apples to apples comparison, but it is conceptually what you just said, Danny, which is one person sells and the next sell, the price goes down and the price goes down. And as more selling is forced to take place, the price goes lower and lower and lower. It causes more selling because everybody sees the lower prices and they think, oh crap, I better get out while I still can. And so you have more sales, fewer buyers because there's less money in the space. Prices go lower and lower and lower, and it triggers that cascading effect that leads to eventually, if it goes too far, that's where you get to stage three, where it's everybody panicking. So that's stage two, is where you start to see the forced sales because money flowing out is flowing out more than money is being coming in replacing it. And then stage three is where these distressed sales create more price effects than the system can manage. And it leads to not just selling in the area we're talking about, in this case, private credit. It leads to market prices that fall farther and farther, and then they spill over into other market segments and other potential markets, which leads to lower and lower prices. And that's when you start to get the big consequences where, in this case, it won't be, we're not going to see another Lehman Brothers fail, but we could see some of these private credit funds go belly up. That's absolutely something that could happen. And we really don't know what that would mean as far as the functioning of the system, but that's more stage three. So you get the sales, you get more outflows, you get the banks that are pulling back, there's less liquidity across the entire system, across the entire marketplace, prices go down, and then you get to stage three where it's just everything just amplifies as the dominoes fall one after another after another.
And how long does this, like, I imagine this can take a matter of hours or a matter of weeks or months or years. Because, like, if you watch Margin Call, like, this is what it reminds me of, that where they start the morning selling their stuff for like 95 cents on the dollar, and by the afternoon they're selling it for like 65 cents on the dollar. That obviously happened in like a day in 2008. But like,
Yeah,
do you expect this to be
the
a much
worst
more
part of stage three. That's toward the end.
you expect this to be much more drawn out?
They're always drawn out. See, the problem is people have this conception that a crash happens overnight. Like one day everything's fine, and the next day everybody's panicking. That's not what happens. Crashes, even the most violent crashes like 2008, were several years in the making. Yes, several years. Same thing with the 1930s. The Great Depression did not happen overnight. The stock market crashed in October 1929. It actually peaked in September 29. The actual depression didn't happen until 1930, 1931, after you got a couple waves of bank failure. So these are drawn out processes, and it takes a while for these things to go, because you got to remember, at every step along the way, there are lots of people who believe this is all a big nothing. That we're overreacting to what is just basically a small thing. And so, like I said, stage one, a lot of investors see, okay, there's some irregularity over there. That allows me a buying opportunity. I can put my money in and get stuff really cheap. So there's always this back and forth. There's never this clear, decisive signal that says we are moving in this direction. And so that back and forth leads to it takes up a whole lot of time as this process plays out. But ultimately, what matters is not the length of time, it's whether or not these imbalances that were created during the upswing in the bubble period can be handled without leading to more systemic consequences. It's a difference between a credit crisis and a liquidity crisis. A credit crisis is something like we saw in the 1980s and 1990s with the S&L crisis. You had a credit crisis in a segment of the banking sector that led to more than 1,000 banks failing in the US, but it didn't lead to a depression. It didn't lead to massive market chaos because it never really became a full blown liquidity crisis. That's the difference between the S&L crisis in the 80s and 90s and 2008. 2008 started out as a credit crisis in the same way. You had overextended lending for lot of stupid reasons. A lot of stupid things took place. A lot of leverage that had been added onto it. So you had a credit crisis. There were losses that need to be taken by the system, but they were so big and so large and so misunderstood that it led to liquidity, the markets breaking down. It led to the entire monetary system breaking down. It led to the banking system breaking down. So it led to much further consequences, which is a credit crisis became a full blown monetary crisis. Um, and in this current iteration that we're going through, we really don't know how shadow banks, the interplay between banks who are funding a lot of the shadow bank activities and the shadow banks themselves, how that could spill over into other areas. So, at the very least, what we're looking at is potentially a credit crisis with some signs and symptoms that suggest it could become a liquidity crisis if it continues. And the reason why we think it's a credit crisis is because just the stupidity, the cockroaches, and everything we talked about at the beginning of this video.
Can you explain that to me? Because I'm not sure I fully understand. Like, why would a credit crisis not become a liquidity crisis? Like, what are the different things there?
Because in a credit crisis, what it really means is that there are hidden losses in lending, right? You lent to people that you probably shouldn't have. Those loans are worthless. Everybody has to take their losses. They're widespread, but it doesn't necessarily lead to all the stuff we just talked about. You can have a credit crisis that never goes past stage one. So the credit crisis is there's lots of losses to be taken by this person, and that person, but it doesn't lead to distressed sales because maybe it's not that big of a deal. Some of these funds that take losses are not sharp enough that it leads to a complete draining of their liquidity facilities. They're never forced into selling assets at distressed prices, which is really what gets into the crisis. So there's lots of losses. There's in some cases there are firms go out of business, banks go out of business, but it doesn't lead to systemic problems further down the road because it doesn't lead to it doesn't create the downside across markets. It doesn't lead to the real depression in prices, the sort of domino effect that you talked about when a lot of forced selling, distressed sales lead to further stress. That the link in the chain is broken by something that proves to be more resilient. Therefore, just as a bunch of credit losses that need to be taken by the system takes those losses usually over a prolonged period of time, but it never really goes past stage one or maybe early stage two.
So is the idea there that it doesn't snowball into sort of public markets? Banks are able to sustain that with their balance sheet instead of having to go and like tap repo markets and the Fed and things like that. Is that the right way of thinking about it?
Yeah, so you can think about it like in the example of the S&L crisis. You had a lot of smaller banks who were exposed, and actually got into repo, but a lot of smaller banks were exposed to mortgage crisis. But they didn't have to sell their assets because there were larger banks, these Eurodollar banks, who were available to buy the assets from them before it became a cascading effect. So in other words, there were bigger banks that were willing to supply funds to the marketplace as needed to keep it all relatively stable. And relatively is doing a lot of work, a lot of the work here, but it was relatively stable that it didn't become a systemic break like 2008 or 1929, 1930, because there was capacity in the system to be able to absorb not just the losses, but those who took the losses, but also to stand behind and provide new funds and new liquidity as necessary to maintain some minimal level of capacity before it really did snowball into something bigger.
If you had to put like a percentage on it, how likely do you think it is that we go into sort of full blown stage 3 here?
Oh, it's really, really impossible to tell. What I would say is that it's a non-trivial risk at this point. Um, so, I mean, greater than nothing, but certainly not, potentially a base case. Though I will say the markets have been pricing something like this for years now, and as we continue to go along, everything seems to move in the same direction as what markets have been telling us to expect the entire time. So that's not exactly a positive scenario to begin with. And what I mean by that is markets have been saying over the long run, interest rates were going to go down. They were going to go down by a lot, and they were going to stay there for a very long time. And so for the last several years, I've been sitting here telling other people to sit here and think about how do we get from there? Or how do we get there? How do we get from where we were, say, in 2022 and 2023, where central banks were hiking rates and everybody thought interest rates are going to go into the double digits, to the market telling them No, interest rates are going to go down. They're going to go down by a lot and stay there for a very long time. And as we continue to progress, you see weakness in the economy. We see job losses take place last year. That's the macro side of it. And on the financial side of it, we've got a private credit bubble that is certainly going bust. That would fit into a range of scenarios that lead us to interest rates going down and staying there for a very long time. So if it does get to stage three, that would certainly fit the forecast that the markets have been sending for several years now, several years during the entire period when this stupidity was building up in the private credit space. So that's why I say the potential for a stage three is probably higher than we would like it to be because it fits within the scenarios that we've been looking for years. That still doesn't mean it's a done deal. It's going to take place, or that the results of it will be catastrophic. It just means that there will be significant enough disruption, disorder, and deflation that it does lead to a situation where we have, the economy's down, more job losses, unemployment's not rising on the macro side. There's financial volatility. There's losses to be taken. There's going to be, disruption, and certainly in the stock market, but if it goes that direction. All that kind of stuff that you associate with it, that would fit into the overall framework that we're looking at.
So the chances are high enough to be paying attention.
Yeah, I mean, that's probably the best way to put it because, when you put a number on something, the numbers change, the probabilities change all the time as we get more and more information. So I mean, I think that's probably the best description I've ever heard anybody say. It's enough to pay close attention to it.
Hey, I'll take that.
The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.